If you and someone else are splitting profits from a business venture, you may already be in a partnership. You don't have to file anything with the state for that to be true. If two or more people are carrying on a business together with the intent to make money and share in the profits, the IRS treats that as a partnership. That means a separate return, K-1s for each partner, capital account tracking, basis calculations, and a level of documentation that most people don't think about when they're excited about a new business. Teleprompter. If you and someone else are splitting profits from a business venture, you may already be in a partnership. You don't have to file anything with the state for that to be true. If two or more people are carrying on a business together with the intent to make money and share in the profits, the IRS treats that as a partnership. That means a separate return, K-1s for each partner, capital account tracking, basis calculations, and a level of documentation that most people don't think about when they're excited about a new business. Idea with a friend. Today we're covering everything you need to know about partnerships, what creates one, how Form 1065 works, the financial tracking that keeps it functional, and the legal realities that every partner needs to understand before a problem arises. Welcome back. I'm Lauren Twitchell, enrolled agent, founder of Zero Fluff Books, and former IRS revenue agent. Partnerships are the most flexible entity in the tax code, but that flexibility creates complexity, and complexity without documentation is where things break down. Let's start with how partnerships are created. You formed a multi-member LLC, two or more owners, and haven't elected to be taxed as a corporation. The IRS treats it as a partnership by default. You didn't choose partnership status. It was assigned based on the number of members. But you don't even need an LLC. If you and another person are sharing profits and sharing control of a venture, the IRS can treat that as a general partnership, no state filing required. The activity itself creates the partnership. Because partnerships can form without formal documentation, you need to create that documentation yourself. The partnership agreement, or operating agreement if you're an LLC, defines the terms. Who contributes what, how profits and losses are allocated, how decisions are made, what happens if a partner wants to leave. Without a written agreement, state default rules apply. In most states, that's a 50-50 split regardless of who's doing more work or who invested more capital. The allocation in the agreement drives how income is reported on each partner's K-1. Get the agreement in place before the business earns its first dollar. A partnership doesn't pay federal income tax at the entity level. It files an informational return, Form 1065, due March 15th. After the 1065 is filed, each partner receives a Schedule K-1 reporting their share of income deductions and credits. Each partner reports their K-1 amounts on their personal 1040. The income is taxable to each partner in the year it's earned, regardless of whether cash was actually distributed. If the partnership earns $100,000 and the partners leave it all in the business, each partner still owes tax on their share. That can create a cash flow problem if partners aren't planning for it. Partners who perform services for the partnership receive guaranteed payments, compensation paid regardless of profitability. Guaranteed payments are deductible to the partnership, reported on the K-1 as ordinary income and subject to self-employment tax. The distinction between guaranteed payments and profit distributions matters for tax purposes. Make sure that they're properly characterized in the books and on the return. Now let's talk about the financial tracking that keeps a partnership functional. Every partner has a capital account, a running balance of their financial position. It starts with contributions, increases with allocated income, and decreases with distributions and losses. Capital accounts must be tracked separately for each partner from day one. Related but distinct is basis. Your basis determines the tax consequences of distributions and losses. You can generally receive distributions tax-free up to your basis, exceed it, and the excess is typically taxed as a capital gain. The losses can generally only be deducted up to your basis. Basis needs to be calculated annually as part of the tax preparation. If you're in a partnership and you're not sure what your basis is, ask your tax professional. In a general partnership, each partner has joint and several liability. That means each partner is personally liable for the partnership's obligations, including those created by the other partner. If the business can't fulfill a contract your partner signed, creditors can pursue your personal assets. Forming as an LLC provides a layer of protection, but even with an LLC, your partner's decisions affect you. The books have to track each partner's capital account. If those accounts aren't maintained, the financial picture is unreliable. The partnership agreement needs to cover 4 specific scenarios that create the biggest disputes. What happens if a partner dies? Does their interest pass to their estate? Does the remaining partner buy out the interest? At what valuation? What happens if a partner becomes disabled? How long does their allocation continue? Is there a buyout mechanism? What happens if a partner goes through a divorce? Can a former spouse acquire an ownership interest? What happens if a partner wants to leave? How is the departing partner's interest valued? Is there a right of first refusal? These are far easier to resolve when the terms are defined in writing before the situation arises. One practical point about cash. Just because there's money in the partnership's bank account doesn't mean each partner can take their share whenever they want. The agreement and capital account balances govern distributions. Distributions need to be planned, documented, and consistent with the agreement. If you and your partner have been taking money out without documenting it, without updating capital accounts, and without considering basis, fix it now. Here's the bottom line. Partnerships offer flexibility other structures don't, but they require the most careful documentation of any structure we've covered. A separate return, K1s, capital accounts, basis tracking, a comprehensive written agreement. If you're currently splitting profits with someone and you don't have a written agreement, that's your priority this week. Next week is the final episode. We're tying everything together into a decision framework based on your business stage, and we're covering the most common mistakes when transitioning between entity types. I'm Lauren Twitchell. Keep the fluff out of your books, and I'll see you next week.